Let's look at the scoreboard for the last 24 hours. The major indices are showing a slight fatigue, a collective holding of breath. The S&P 500, SPY, is down 0.20% to $693.77, and the tech-heavy QQQ is slightly softer at $626.24, down 0.15%. Even the small caps, represented by the IWM, show minor weakness, registering a fractional loss of 0.06%. This isn't a crash, it's a subtle drift, suggesting the market is digesting the influx of fresh data points rather than rushing to a conclusion. What is driving this slight pullback? We have two powerful, conflicting macro reports hitting the wires. On one hand, we see US unemployment rising to a 4-year high according to the latest jobs report. That typically signals a loosening labor market, which the Fed should welcome if they fear inflation. On the other hand, the CPI data shows inflation remaining stubbornly steady, not accelerating, but certainly not collapsing either. This sets up the classic market dilemma. Are we heading for a slowdown, or are we stuck in a sticky inflation zone? The market is trying to decide which story wins out. This indecision is perfectly mirrored in the volatility index. The VIX, the market's fear gauge, ticked up by 2.50% to 16.38. That's not panic territory, but it confirms that the air is thicker today. The low volatility calm we've enjoyed is being challenged as investors price in uncertainty surrounding the Fed's next move, especially when juxtaposed against these slightly disappointing employment numbers. The market's direction is often set not by algorithms, but by the pronouncements of those who shape policy and capital. Today, the VIP lounge is incredibly active, providing color on everything from AI ethics to monetary philosophy. Let's start with the central bankers. We have fresh commentary from Jerome Powell, where his pushback on interest rate scrutiny seems to be working. Markets are respecting the Fed's purported independence, for now. Simultaneously, we hear from Europe's Christine Lagarde regarding interpretations of Powell's recent statements. This implies that global central banks are still in lockstep, watching the US playbook closely. When central bankers speak with a unified, cautious voice, risk assets tend to temper their enthusiasm. Then we pivot to the titans of industry. Jensen Huang of Nvidia steps up to tackle the AI narrative, arguing that AI doomerism is causing damage. This is crucial because NVDA itself is showing strength, up 0.47% to $185.81, bucking the general market trend. Huang is essentially vouching for the long-term viability of the AI sector, perhaps trying to soothe any lingering anxiety about overvaluation or technological roadblocks. Contrast this with the prognosticators of doom. Ray Dalio is sounding his usual alarm, warning that all fiat currencies are in trouble, and predicting a major devaluation cycle. This echoes the persistent inflation data we just saw. When heavyweights like Dalio preach monetary skepticism, we often see a flight toward hard assets, which brings us neatly to gold later on. And finally, in the corporate arena, we see structural shifts. BlackRock's Larry Fink is reportedly slashing hundreds of jobs to kick off the year. This isn't just one firm. It's a clear sign that Wall Street is recalibrating its expense structures for a potentially higher for longer rate environment or simply absorbing the shock of an uncertain economic future. This layoff news often acts as a minor drag on broader sentiment, reinforcing the narrative that the easy money era is firmly over. If the stock market is whispering uncertainty, the bond market is speaking volumes through yield. The benchmark 10-year Treasury yield, TNX, has slightly eased, sitting at 4.17%, down 0.38%. On the surface, a slight dip in yields might suggest markets are buying bonds, anticipating a Fed pivot or perhaps acknowledging the rising unemployment figure as a precursor to weaker growth. However, we must remember the context. We are still dealing with sticky inflation reports. If the Fed has to keep rates elevated because inflation won't budge, then this dip in yield might be temporary. A classic, buy the dip, in Treasuries before the next inflation data point shocks the system. The headlines confirm this tension. Discussions abound about when mortgage rates will finally drop, with one big wild card remaining, which we know is the Fed's terminal rate decision. The fact that lenders are still advertising rates at 5.5% and below indicates we are operating in a high-rate environment relative to the last decade. The bond market is currently pricing in just enough concern over economic weakness to temper yields, but not enough concern to signal an imminent collapse in inflation or a guaranteed rate cut next quarter. It's a delicate balance point, reflected in the moderate move in the TNX. Our central bank focus is squarely on navigating the gap between employment weakness and persistent inflation, the dreaded stagflation light scenario. The news that US unemployment hit a 4-year high is the most potent countersignal to the steady inflation data. If job losses accelerate, the Fed's mandate to maintain maximum employment becomes prioritized. This is what traders look for to justify potential rate cuts, labor market deterioration. However, the ECB and the Fed are dancing to slightly different tunes, as highlighted by the commentary around Lagarde and Powell. While the ECB is trying to manage its own localized inflation pressures, the US narrative remains dominated by the Fed's reaction function. Jamie Dimon's warning that interfering with the Fed would push rates up serves as a reminder of the political tightrope Powell walks. We are in a holding pattern. The market anticipates the Fed wants to cut rates to alleviate unemployment stress, but they cannot risk cutting if inflation stays steady above target. This tension keeps rate hike expectations, or at least rate hold expectations, firmly anchored. Until the CPI data moves decisively downward, the Fed's hands are tied, which supports the current elevated yield environment despite the jobs report cooling. The commodity complex is showing fascinating divergence, telling a story about geopolitical risk versus global demand destruction. Leading the charge higher is gold, GC equals F, up a strong 1.11% to $4,640.30. Gold is the classic safe haven asset, often rising when confidence in fiat currency stability wanes, as per Dalio's warnings, or when geopolitical uncertainty rises. Furthermore, the slight weakness in the US dollar index, DXY, NYB, which is flat but slightly down, minus 0.01%, removes a headwind for dollar-denominated gold. Conversely, crude oil, CL equals F, is retreating, down 0.85% to $60.63. This is a demand signal. A falling oil price suggests that the market perceives slowing industrial activity or economic growth ahead, consistent with the rising unemployment figures we discussed. Oil is saying, demand is weakening. Gold is saying, uncertainty is high, and the dollar might be soft. Adding another layer, the general headlines note that cotton holds its gains. While minor, this speaks to agricultural supply chain stability, or perhaps a localized strength in textiles that doesn't yet translate to broader industrial strength. In essence, commodities are signaling caution. Hedge against financial instability, gold up, but brace for economic slowing, oil down. The Forex market, represented by EUR/USD equals X at 1.17, minus 0.11%, remains relatively range-bound, showing that the dollar's current slight softness isn't yet a wholesale rejection of the greenback, but rather a standard fluctuation against a steady euro. Now, let's zoom in on where the money is flowing within the US equity market. The divergence here is acute, carving out clear winners and losers based on today's data narrative. The leaders are clearly the AI innovators and defensive quality plays. Nvidia, NVDA, is up 0.47%. As Huang suggests, the long-term story is intact, and investors are sticking with the growth leader despite market jitters. Similarly, Apple, AAPL, is up 0.31% to $261.05. Apple often performs well when sentiment is uncertain. It's seen as a high-quality balance sheet holding. The clear underperformers are the cyclical heavyweights and the large tech names most sensitive to high discount rates. Microsoft, MSFT, is down a substantial 1.36%, and Amazon, AMZN, has dropped 1.57%. Why the differential? MSFT and AMZN are deeply entrenched in enterprise software and cloud spending, which can be the first areas companies rationalize when facing rising unemployment and economic headwinds. They are pricing in a potential slowdown in corporate IT investment more aggressively than consumer-facing hardware, Apple, or pure AI hype, NVDA. The major lagger in the broad indices is the small cap IWM, minus 0.06%, confirming that smaller, more domestically focused businesses are the most sensitive to domestic economic deterioration like rising unemployment. The large caps are showing resilience based on their global exposure and perceived quality, even as they drift lower overall. The digital asset space continues its moody trading, somewhat detached from the immediate macro turbulence, yet still sensitive to global liquidity. Bitcoin, BTC/USD, is pulling back slightly, down 0.32% to $95,013.59. This mirrors the general risk-off sentiment seen across the broader equity indices. However, Ethereum, ETHUSD, is showing surprising strength, ticking up 0.20% to $3,328.77. This divergence between BTC and ETH is always worth noting. Often, when Bitcoin trades sideways or down, Ether's relative strength suggests renewed enthusiasm for decentralized finance, DeFi, activity, or perhaps anticipation around upcoming protocol upgrades. Investors are favoring utility over pure store of value play in the short term. The VIP commentary provides texture here. Michael Saylor fiercely defended the Bitcoin treasury model, suggesting absolute conviction in the asset's long-term store of value proposition, which acts as a bullish underpinning. In contrast, the general macro uncertainty, sticky inflation and rising unemployment, should, theoretically, be bullish for Bitcoin as an inflation hedge, but the immediate price action suggests traders are de-risking first, hedging uncertainty with cash or quality stocks rather than jumping headfirst into digital gold today. Looking forward, the next 24 hours will be dictated by reconciling the jobs report with the inflation data, and watching for any reaction from the political sphere to the macro environment. We need to watch the stock market reaction to the futures market open. If the selling pressure continues in MSFT and AMZN, it signals that recession fears are gaining ground over AI optimism. Conversely, if NVDA maintains its strength, it means the growth narrative remains insulated. The critical factor will be the treasury market. If TNX starts rising again above 4.20%, it means the bond market is rejecting the idea of immediate Fed dovishness despite the unemployment news, and we should brace for more tech selling pressure. We should also monitor the international response, especially in the EU, given Ursula von der Leyen's comments on Iran sanctions, which can inject geopolitical uncertainty and support gold further, creating a more volatile mix for US traders trying to price risk. Today's market isn't sending a clear signal, it's sending a mixed signal layered with competing narratives. We have evidence of economic cooling via rising unemployment, yet inflation remains stubbornly present, handcuffing the Federal Reserve. The result is a market that hesitates. Big tech is bifurcating, quality and pure AI growth showing green, while enterprise-facing giants take modest losses. The smart money, symbolized by the VIX ticking up and gold rising, is demanding a premium for taking risk. Thank you for joining me. We'll reconvene tomorrow to see which narrative prevailed.